reintroduce ourselves. My name's Levi. I'm with Rate Mortgage.
Now, I'm Leanne Osteen with Great Mortgage.
And I'm Stephanie Brownlee with Guaranteed Rate Mortgage.
You threw a guaranteed in there.
I had to be different. I had to be different.
So what we're talking about today is, our goal is to help you guys close as many transactions as possible. So that is, what we're gonna be going through today is clients that may not fit the traditional box. And by traditional, I mean FHA, VA, conventional, USDA. If they don't fit those agency guidelines, we do have options to help them get into a home, and help you close on the home, get paid. So that is where our rate portfolio comes into play. So this is a custom suite of loan products, just to help with the clients that are kind of outside that box. So what a lot of lenders do is they'll, for these types of people, they might try to cram them into the box, which makes for a bad experience for the customers, and it may not even work out, so. Now, a few of these different programs are, number one, for self-employed borrowers. Typically, I'm sure you're aware, lenders usually want to see 2 years tax returns, and they're going to look at what they filed on their tax returns for their income. There's certain items we can add back in, but it is tax returns that lenders go off of. And so with this program, we don't need tax returns. We're going to qualify them. We can either use 1099s, we can use bank statements to show cash flow of the business. So we're going to look at what's going into the account, what's coming out of the account to determine what their qualifying income is. We can also use a CPA certified profit and loss statement. So that would have to come from the CPA certified on profit and loss. So this is also a big one for you guys as realtors. As realtors, you're familiar with filing your tax return, probably trying to get your income down so your tax liability is lower. But then you have an issue when you go to get a loan or get
Are there
credit.
any disadvantages to this since you don't have to give tax returns? It's something.
The main disadvantage is the down payment requirement is gonna be a little bit higher, 10% down is the minimum. But not too high, but on a traditional, conventional, first-time home buyer, 3%. VA 0, so it's a little bit higher down payment, then the interest rate is a little bit higher. But it's only about 0.25% higher, so it's not bad.
Pretty good considering, you know.
Yeah.
I think it's really nice because Levi and I both, and Stephanie come from the banking and credit union world, where we were so limited on the products. And so when we got customers and clients sent to us, we would try to put them and fit them into those products. And really the reality is not everybody fits that mold to go into the products. And so this is now there's just an array of options that are available to us to fit folks into the right loan that they should be in based on their situation. So.
And generally, when I'm talking to a customer about these different programs, if they don't think they may fit the mold of a traditional financing, I'll look at their tax returns first.
Yeah.
Just because of the lower down payment, lower interest rate. And then if it doesn't quite meet what they're looking to do, that's when I'll explore either bank statement, 1099, profit and loss.
So is the rate a little higher than on those?
About 0.25% higher. It's not too bad.
And you can use this for investment too, or no? So
we do have
DSC
investment, the debt service coverage ratio loan. We'll go over next. So next is on investment properties. And that is where, again, we don't look at tax returns. And how we're gonna determine income is based off the income off the property you are buying. Called the debt service coverage ratio. And so it's actually pretty low. So what we require is we just need the rent to be equal to or greater than the monthly payment. So just the DSCR of 1 is what that means.
And is that a secondary market product?
So we keep them in, we do the underwriting in-house and then we do have investors.
after the.
And what would be the term on those investor related? But they're only for residential properties, right?
1 to 4.
1 to 4.
Yep.
And how, but the term is a 30-year.
We can do 30. Yep.
Fixed rate.
Yep.
Good product.
And how do you determine the rent? You can't just say whatever.
So-
Appraisal.
Yeah, so, and they're gonna take the net operating income and they're gonna divide it, by the total debt obligations of that property. So that's how they're gonna determine.
Got it.
When you say the monthly payment, you're saying the whole monthly payment, including taxes and insurance.
EITI.
So that's interesting. So what happens if there has not been a tenant in the property in advance of the purchase?
So, yep, we do a appraisal. So the appraisal will determine market.
Appraisal determine market value for the rents,
Mhm.
and presumably the lower its number of the range.
Yeah.
Yep.
Yeah. Okay, that's really good product.
Tom's thinking like an underwriter.
Yeah.
You're gonna go on the low side.
Well, I've been kicked in the shins before.
Yeah, right. And a lot of you probably have heard the max number of finance properties of 10 before. We can go up to 20.
Wow.
And I'm sure you've also heard that vesting for title has to be in an individual. This we can do in an LLC.
Which is very common in investors want to do that.
And where is the interest rate environment for this product?
So this one, I actually pulled rates this morning.
Look at this guy.
I can tell you where rates are at. So on the DSCR, 75% LTV, so 25% down, 30-year fixed rate with no points, so no discount points, you're not buying the interest rate down, with a 7.875.
Pretty good for investment.
You said 7.8 combined.
Yep, with no discount points, so you can of course buy it down from there.
But you think about if the market today for a commercial loan is, let's say, 7, the longest you're gonna be able to fix that for is 5 years. And you're probably going to be looking at similar down payment requirement.
Probably a 20-year.
And the amortization, that was the next thing I was gonna say. You might get 25, but you're gonna have 20 to 25, you're not gonna likely get 30. So this is a good alternative product, particularly if you don't have to. The other thing about that commercial loan, you would have to be able to have a very, very strong balance sheet and to be able to do it. Whereas so let's talk about that. What's the credit score requirements? 660
is the minimum,
Okay.
but as the credit score gets lower, so does the LTV. and
Sure.
Of course, get higher.
Yeah. That's cool.
Yeah. And as far as the interest rate when compared to maybe a commercial product and their AM, investors are typically more concerned about cash flow because they typically understand it's not me paying the mortgage, it's the tenant.
Correct.
So
Really good
they're
point.
looking for cash flow. So
Other
just being able to
people's-
extend that amortization.
Right, presumably even if you're a point higher or 7,500 basis points of a point higher, if you've got a 10-year longer amortization, you have the greater potential to have increased cash flow.
And speaking of cash flow, is we do have interest only options as well.
So for like, if you want to renovate and then,
Or just you want a lower monthly payment. You're looking at just cash flow. So,
Obviously, you don't build any equity with that, but you can, if you're like, I really want these payments to be lower while I do stuff that I want to do with my money, then you have the option.
Can you explain that more, please?
Yeah, the interest only, like you would pay it for whatever the term is.
about a 10-year term usually
Yeah,
on the
usually a
interest
shorter
only.
term. And then by that time, it's almost like for lack of a better description, like a substitute for an arm loan in a way. But you're paying just the interest, you're not paying towards the principal, so it's a much lower mortgage payment. And then you wanna probably refinance, or pay it off in that shorter term. You know, so it does, cause then the principal will come in.
Okay.
Because at the end of those 10 years, it'll just be a fully amortized 30-year loan.
Right,
So it's actually a 40.
and you're not building equity,
Okay.
you know, cause you're just paying that.
When you
interest.
refinance it, then?
No, you don't have to refinance.
Oh, you don't have to
It
refinance.
just
No, you
rolls
don't
over
have to,
into-
but
and
You probably would.
can you pay principal down?
Yeah,
in that
yeah.
period?
So just leaves it
A lot of
more
flexibility.
flexible for you.
So in a scenario where maybe you've got a duplex and you're renovating one side and you've got, maybe you bought it for 400,000 and you gotta put 60 or 70,000 one side. During that period, at least you'd be paying interest only for that 6 or 8 months. Yeah.
So what would rates?
Hey, Levi,
On a, oh,
Hello?
God's
Levi?
asking a question.
hey, yeah, no, I just, you don't need to go into it again. I just was trying to write down here the formula. And you said rent has to be equal to or greater than what?
The principal, interest, tax and insurance payment.
Got it. Okay.
What'd you have, Chen?
oh, just, what are just normal rates for investment right now if you didn't do this program?
So they're actually,
25% down, I mean, if you had good credit.
yeah, so you'd probably, this one's at probably similar range on a conventional.
You'd be.
I-7
Yeah,
for well qualified.
Okay. Good program.
So that's the DSCR. So next would be for your higher net worth clients. This is our asset qualifier. So these are for people that are high net worth, but maybe they don't have income, they can't show income. So what we're doing here is there's two different options. We can use their assets as income. And so to do that, we would use their total eligible assets over 7 years. So divided by 84, and that would be their monthly income that we can use. You also may hear about this as asset dissipation. Is what it's referred to a lot in the industry. And you can actually do this through Fannie Mae and Freddie Mac on the conventional side, but they can't use as much of the income. Because they're gonna restrict it to, we have to divide the net eligible assets by either 240 for Freddie Mac or 360 for Fannie.
What assets would qualify?
So there are, bank statements, retirement funds, and there's actually percentages of.
What about rental, what about houses, I mean, then.
No, it's just liquid assets.
Liquid assets, so.
Yeah, because otherwise we're getting tax refunds.
Right.
Do 401ks count?
Yes. Yeah. But if it's employer sponsored 401k, we'd have to get the terms withdrawal. Make sure they can withdraw it. And so that's the asset dissipation, is using the assets as income. And then there's also an asset qualifier where we're just looking at how much do they have and compared to how much are they borrowing. So if they have over 125% of what they're borrowing, then we don't need to determine income. That means whatever they're borrowing, they need to have that plus 25% of the bank. They may not want to use that money, they may want to leave it invested or whatever else. Great option there too.
And those rates are competitive too.
Yes, so on an asset qualifier, 30-year fixed is around 7.375 with no points, and they can buy it down.
Credit score same.
Yep, yeah. About 660.
75 LTV, 75.
So we can go, yeah, we can go up to 80%.
Most of those folks have that kind of, they're already gonna put that down probably.
Yeah.
It just makes it a lot easier for these folks that don't wanna do the scrambling around for documents too. Cause that's one of the biggest pain points that we face as lenders, is like we send that list out of like, get all your stuff together. And this really on some of these products makes it super easy, especially for business owners and self-employed borrowers, it's like not having to get their well, they might have to get their P&L, but like their taxes and just, all of the things that come with it. So it's just, it really minimizes.
Well, it can save them a lot of money in taxes, because some people, they change their tax strategy based on if they're projecting to need to get credit or not. And so they may show more income just so that they can qualify for a loan the next year.
They sell some of that and take the hit on that, so. buy.
It's tough, because then you're paying tax on it, and when you got a program like this, that really helps out. I'd rather pay a little higher rate than.
And write that off on your
I don't
taxes.
mind, yeah. So, that's why in this business, we have so many write-offs, we don't show a lot of income.
Yes. Next one, I need to like put this next one in bold, because this one is how we can help your clients buy without being contingent on selling their current house.
Or a bridge loan, we don't need it.
Yep. And so the way we do that.
Talk about these three.
I gotta have myself, yes. That's the utilization we have to talk about. Okay, so there's two main options we can do. Option one is if the client plans on selling their house, but it's not listed yet. Then we just need a letter of intent signed by the customer. If they plan on listing the house within 90 days of closing on the purchase. And then to do this, they need at least 20% equity in the departing residence. And how we determine that is we do have to get an appraisal on the departing residence. The reason we need 20% equity is we need to make sure if they need to reduce the price.
Did you say you have to list within 90 days? Is that what you said?
Yes, they just sign a letter of intent, just saying, I intend to list the property for sale within 90 days. So it either has to be listed for sale, or we get that letter of intent that they plan to list it.
You can't use what it's assessed at on the DC assessor if.
Not for this option. Second option would be if they're under contract,
Where it's
But they're not-
listed.
but they're not gonna close until after they buy the new one. So if they're closing within 30 days of closing on the purchase, then we can use whatever they sold it for. And we don't need to do the appraisal.
Yeah, we're not counting that property against their debt to income. I mean, that's the whole purpose of having to get a bridge loan. And so that's the biggie, is that we can omit that debt, and it really, it helps us see like, okay, then they actually qualify. And so,
If they didn't, you do have to get a bridge loan. How much are your bridge loans?
so, and we source out our bridge loans, but you know, they are a much higher rate, and, you know, with the bridge loan, you have to guarantee that it's gonna be sold within usually it's 6-month term. That you're essential, and then when we have to still, as lenders, when you get a bridge loan, we still have to use that DTI based on what your payment is on the bridge loan, you know, so it's still hitting us with a mortgage.
I haven't had the best experience with.
They're not
Some
fun.
people have gotten lenders that they didn't really care to work with. The
Yeah.
appraisal was high. I mean, they're like, it just doesn't always, sounds great.
Yeah, and it's thrown out like
It's a necessary evil, but this is a nice alternative.
yeah, it's thrown out so much, like, well, we'll just get a bridge loan. Well, it's not so easy. And it doesn't really solve a whole lot of problems, you know, but with this, they still need to have like their down payment and stuff. So like, as long as they have that down payment, and I just did one, just closed a few weeks ago. But he didn't have the down payment, but his parents were able to give him that down payment. And his house was sold, it was under contract and closing after our closing date. And it all worked out. But the biggest thing to take away is that we can omit that debt to income. And so it's just a much cleaner, easier way. Then you're not fumbling around, messing around with that bridge loan after you close on the other house, even if you qualify for it.
What
It's best
happens,
for people that maybe their income isn't quite enough to cover both house payments.
Right,
That way, we're only hitting one house payment.
which happens a lot.
what happens if they don't list their house in 90 days?
I'm not gonna be like searching Zillow. But it's in their best interest, you know, obviously to, you know, get that debt going. There's a concern with mortgage fraud, you know, but that goes with everything.
I'm just thinking like if their intention changes, something happens and,
I mean,
Intentions change all the time.
yeah,
sure,
At closing, they're signing a letter of intent. They didn't plan to list it.
but or Levi and I can be searching Zillow for it now, but that doesn't mean that the investor is
I was gonna say, is there a follow-up on that?
possibly.
Okay.
However, I've never-
Typically, I mean, where people can run into problems is if right after closing, whatever house they said they were going to,
Occupied the
sell,
primary or something.
then it goes up for rent on Zillow. And it's like, I thought you were selling that.
That's
Yeah.
90, a lot can happen in 90 days, that's why.
Yeah.
Yeah, and things do happen, but you know, just as long as we don't, we're gonna ask them like what their intent was, obviously, so we structure everything right. Because the ultimate thing, like, for us is that we're setting people up for success, like, to be able to make their mortgage payments, to stay in that home that we're financing. It's not just about closing them and being done. Because we, you know, we have to, I'll sometimes deal with the aftermath if they get foreclosed on, you know, which that's, ultimately, that is not what we want.
Any
So if I heard you correctly, they have to have 20% in their current house, correct?
That's correct, and the house is not under contract.
Okay,
The
what do
house
they
is all-
have, what do
the
they
house
have
is
to
all-
put down then on the new house? Is there a minimum they have to put down?
So 10% down is the minimum. for
10%?
this program.
And it's a conventional product.
Is the rate a little higher?
No, I just did one and the rate was actually really competitive. We did a conventional, locked it in about a month ago, and the rate was at a 6.625. Well qualified buyer.
Okay,
Yeah, the rate's, comparable to normal conventional.
okay.
And to go off that, so you don't need equity in the departing residence as long as it's under contract. And what I mean by equity is they still have to net a positive amount with the sale. They can't be losing money. But there isn't a requirement on how much.
And then 20% is appraised value or valuation, not net
Yes.
proceeds. Okay,
It's really awesome.
So,
so I'm looking for the catch. There's I need that.
Right.
You know, I was too, honestly, like, cause I did my first one last month and like, I was like, okay, so what? It really was.
No
clean.
prepayment
Very
penalty,
clean.
no.
No prepayment penalty.
How long does this program go on for, like, for?
This is a
until-
program that we have.
That you always, you're gonna have for going forward?
I mean,
Until
I
unless
can't
it
speak
changes,
for the
unless they
mortgage
change.
guys, but they won't change it.
until we don't.
Yeah,
Until we have.
I haven't thought it, maybe I haven't thought it through enough, but how would that show for terms on a purchase agreement? Is it any different as
No,
far as?
because it's really more on the financing side. You would still write it up with your normal down payment. It's a conventional product.
Okay.
It's more so like what we
Not
do on our
contingent on a
underwriting
home
side.
sale. Not contingent on a home sale.
No,
That's a big thing.
Can they recast?
there, I don't believe that you can recast it, because once we close on it, it does go to one of our investors, Onslow Bay. And I don't know that they allow a recast.
Okay,
But the one other thing to mention, since she mentioned our investor, is we do underwrite these in-house.
Yes,
So we're not.
we're not subbing it out to somebody else.
That leaves. Gives us a lot more control, which is what we want on our end.
Do you have a flyer for that? Like,
I can search
We can
our,
share.
I can search our library and see.
that'll be
in
good.
your opinion, yeah.
Can the 10% down come from the original house, or they need that
So
like upfront?
yeah, so
Okay.
that they would need to have their funds to close.
Okay,
Cause we're basically just, the main point of this is we're omitting that previous mortgage from the debt to income. But whatever proceeds they were gonna utilize, that, like in my case, I had to get, he had his parents gift him those funds.
okay.
And then a gift, like, you don't promise that you're paying somebody back, or whatever they do after the fact is up to them, you know, so.
So if you're flush enough in that house, you say you have 50% equity, could you take 10% mortgage, 10%?
We can't use that into the mortgage.
You can't use that
Is it down?
down for the next.
Were you gonna ask like a
Home equity.
home equity? So
Yes,
you actually
I
had
could
the
think
cash.
that
Yeah,
way,
'cause you
yes.
you could do it that way too, I mean, that's a whole other.
So you could, so if you had 50% equity, you could take 10% out of that for a home equity.
If you did like a home
Payment
equity
on-
loan, not on this one, like, are you talking about taking, so here's the problem with home equity loans, if you do it that way, are you talking about taking a home equity?
To get
and
the
then
10%
using this
down for
product?
the next.
So you
Purchase.
can't usually take a home equity if that property is listed. So, and that's just back from banking days. Like,
But you can take the home equity before you lift it.
Could,
Yeah.
you could, you need to do it right.
But then does that play into their debt to income?
Yes, because we're gonna hit your debt to income with the monthly payment on the home equity. But that's usually pretty small, like if
Yeah.
you're just taking out 10%, it's not huge.
Not gonna do that.
That's all that's like months ahead, but you could do it that way.
Okay, so, yeah, just a quick recap, so these are fully dedicated or delegated, meaning they're underwritten in-house. Pricing is actually real aggressive, I mean, interest rates are pretty good on all these. Flexible terms from 50 to 40, again, that 40, that's the interest only. So first 10 years would be interest only, then it would be amortized over 30 for the remaining 30. We do have fixed and ARM options. And there's also, I know you were mentioning prepayment penalties. We can do them with no prepayment penalties, but we also have options with prepayment penalties. So if somebody's planning on being there a while, we can look at that, because that helps us get the interest rate down. We do add in, say, a 2 or 3 year prepayment penalty.
How much do you think it takes the rate down then?
Oh, I think it's roughly like 8 to 1/4% per year. The 1 to 4 unit homes, warrantable and non-warrantable condos are allowed. Again, the DSCR is up to 20, not 10 properties. And, yep, LLCs, you can invest in an LLC. So again, this is just to help you guys close more deals. So take those clients that don't fit the box and smash them in, get them.
And we've all done it.
Yeah.
So this is really great.
Yeah.
Just one more question. Do you have anything that offers less than 12 months verified income? Yeah, 12 month on anything or less than 12 month on anything?
Minimum is 12 months, and for like the self-employed, people where we're doing week bank statement, P&L, or 1099, we can get by with 1 year, but the business has to be in existence for at least 2 years.
Okay. About gap in employment?
Depends on what kind of loan product you're dealing with.
We had an agent that had a buyer that had been incarcerated. And he'd only been out 11 months.
Okay.
So,
Are they self-employed or where's this?
no.
No.
But hadn't been employed for however long before that.
Okay.
So if they have a 2-year history of either that position, like before their gap, that we can prove. A lot of the products will allow for that gap, and especially like we would obviously explain that to an underwriter. So like, for instance, like I'm doing one right now that's VA, and the buyer took a year off after he got out. But before that, he was in the service for 28 years. And so one thing that we wanted to be sure of is that the new job that he's been doing for 1 month, actually less than a month, he has 1 paycheck start. Is that it's something that coincides with something that has to do with his military training. Same thing goes that I run into is like people that stay home with their kids for a little bit, but they were in school before that happened or something like that. Like we can get transcripts and stuff like that to make a case for it, but we have to have a 2-year history. Doesn't have to be employed necessarily, but it has to show that they have, and then they do need to have full-time employment on their new job. So it can't be like part-time or variable income.
Or sometimes too, they work while incarcerated as well. So that, as long as we can have some kind of documentation to prove that as well, to help build up that history.
That it wasn't a true gap.
Yeah. That's not always.
Since we're speaking about employment history, I mentioned that for self-employed people, the business has to be in existence for at least 2 years. But we can make an exception for people as if they've been self-employed for at least a year, so a minimum of a year, and it's in an industry that they've already been in for at least 2 years. So if they went from, say, a W-2 employee to a 1099 worker in the same industry, then after they've received at least 1 year of 1099 income, to really use that.
Back in the day, it used to be, you had to have 2 years and then your business had to be in business for 5 years, so this is, slowly catching up with like what's really going on, you know, to make it where more people can get it.
All right, and we are your team.
And then Stephanie, we're gonna have her talk a little bit about IPA. You're okay with that? Yeah. So she's just gonna give a few little tidbits on IPA.
So yeah, I'm Stephanie. I'm primarily gonna be located in our Council Bluffs office. So I specialize in Iowa Finance Authority, so we call it IFA for short. But I know a lot of you probably have heard of NIFA, and so I'm not gonna touch on it too much, but just kind of the differences between NIFA and IFA. So the key difference is that Iowa Finance Authority actually offers a grant. Or you can do the 5%, just like NIFA does as well, so that's still an option, but the grant is for $2,500. So, and it's a grant, right, so it doesn't need to be repaid like the 5% second does. But it's a great option if you have, you know, clients that just need a little bit of extra help, but you don't want to necessarily go seller concessions. It's a great option there. Rates obviously are still competitive. They're set by Iowa Finance Authority, but they're still in that competitive range. And honestly, it's free money is what I tell people. So if it's, you know, of course, there's income limitations, but if they fit in that box, you know, I usually encourage them to at least consider it. So, and then the only other difference with our second is it's a 0% interest, whereas NIFA is 1%. So little differences there, but it's kind of the same basis, you know, income requirements. There is a max purchase price, but that's like 500,000. So, and then what else?
About payment on the second.
Oh, yeah, no
That's
payment until the first is paid off. So that's obviously a huge thing, that they don't have to worry about it. It's collecting 0% interest that entire time. So, but it does still need to be paid off. So a lot of people, I do try and remind them of that, because when you pay off the first, you do have that second. So that's something to still think about. It's not free money necessarily, but it does collect 0% interest.
Because NIFA does have a mortgage payment for that second. So for people that are real concerned about monthly payment, NIFA does increase the payment. But
Like a 200, 250 is usually about $100 extra a month on that. It's a 10-year term.
Not right?
Yeah.
They want to go over the state line.
Yeah. Any other questions that I can help answer for Iowa Finance Authority?
Or anything really.
Or
guys.
any,
We'll
yeah,
open
any
the
questions
floor
at
up.
all?
Y'all have any questions? A lot of info.
Thank you guys for doing that.
Yeah.
Thanks for coming. Yeah, taking time out of your day.
And if y'all haven't used those, please give us a shot. You know, like, we're here to help. We love to.
As soon as I find some
help out.
clients.
Hey,
Yeah.
that's all right.
Okay. Do you guys want to go ahead and jump right into the huddle since we only have about 21 minutes? Okay.
We took more than 20 minutes.
We had a question.
For lunch, guys.
It's delicious.
Do any of you have any questions? Well, I have some questions, but if any of you have anything pressing you'd like to bring up that's been a challenge for you lately or anything like that, let me know. Okay, well then we're gonna, go with the questions that we had planned. We've heard quite a few stories lately about buyers backing out at the last minute or having had a hard time committing to buying a house. Have any of you seen or heard of this or been directly affected by it? It just seems like it's happening more often.
Do you think they're just seeing a bunch of them and when waiting to see which one they're gonna get approved? Do you know what I mean? They're putting in offers on different ones?
It could be, it seems like sometimes though it's been closer to closing, like right before
I had a
closing.
deal fall
Yikes.
through 2 weeks before closing, but the buyer lost their job.
Oh,
yes.
right.
I had one fall through, at inspection time, and there was nothing, like, we talked about all of it before we wrote the offer. they were reasonable things that could be repaired, and they just didn't even wanna have a conversation with the sellers.
Huh. So they, yeah, that was kind of their out and they just.
I had one that the appraisal kind of was trying to blow it up. The appraisal came in ridiculously low. And then they said, well, if they don't think it appraises that high, we don't, even though we had appraisal, then we don't want it.
Huh.
So
then
did
they end up not,
Well,
did they not go through with it?
well, we had, it was pretty ironclad. They were trying not to. They sent us something to release the earnest deposit to them and but they said they would pay any appraisal gap. Literally said any appraisal gap.
Huh.
And we suggested, why don't you go to another lender? And they said, they said, we don't want it. I have the side and the agent said they don't want it because now they don't feel the value is worth it. Finally, we said, well, kind of committed to it. They said, okay, we'll get another lender and try another appraisal. So we'll see. Unfortunately, it wasn't.
But then if it doesn't appraise again, you're back in the same spot.
We
can't-
are and they are. And it's, I mean, I guess nothing's ironclad, but it's about as close as it gets. They're putting significant down there.
I think if we said any gap, I don't see how to, we get out of it.
Yeah.
And it's conventional.
Conventional, so that it wouldn't stick. Yeah, it's kind of a weird one. Sellers cost would be, some sellers cost would be paid for closing. But I think people get caught, I guess to the original thing, I think people get caught up in the emotion of wanting the win, wanting the house, so they'll go X amount over and over and over. And then they have that buyer's remorse before closing. We saw that last couple of years too.
I ask a couple more questions about that, just because we've been talking about the effect that escalation clauses have on appraisals. How much over list price?
So we went significantly over with 4 offers. One of the offers we didn't take was an escalation. So there's a fair amount over.
Yeah.
Did the appraisal come in at the list then, or lower than list? Wow.
So any more like issues with those or, I mean, I'm sure other agents too, we've had that happening. We're talking about buyers backing out. Just how they're seeing more of that lately, like it seems like it's been more of an issue.
I think it absolutely has. We kind of talked about it the other day.
Right. What about the market in general right now? Like, how are you feeling? Or is there something else?
It's not in just a specific market, you know what I mean?
Right.
Like it just, you can't just say it's this.
Depends on the price range for sure.
Yeah. And when you think you have it, don't spot it, it changes just like.
It's unusual. Some things are going super fast, some things you have, and some things even in like that first time home buyer are not fast. It's just, it's very strange.
What price range do you feel like? Is there a price range that's more like they're getting more offers and moving right away? Or would you say that's not really?
Well, I think that under 3 is probably, it's kind of always been the same, but even in that, I think buyers are right now much more discerning. So even at that under 3, I think that we're pricing them better. You know, we're like a 280 now. A couple years ago, when we were in that frenzy, it was going for 3 or even starting at 3. Buyers were like, this is not worth that, like, you know, and so I think buyers, even in that under, are like, yeah, it's nice. So things that have houses that maybe are more fixer-uppery, I think are not getting multiple offers. So that's why it's a little bit strange, even in, they still go faster than the other price ranges, but yeah.
The other thing I think is buyers might be getting a little weary because on some regards, because I just had an open that was 500. And a couple different people are like, well, it's been on the market a couple days. I don't know if I even want to offer. Because they think they're gonna be competing. And how many offers do they have? Like they're asking those questions. And, you know, I worked them through it, but it's interesting.
You mean they wanna wait until it's been on the market?
They just don't want to compete. they just assume if it's been on a couple of days, there's already offers. I've already lost, the guy's like, I've already lost once, I'm not trying to do that again, and. so.
And I do feel like there's more buyers that are slow playing, so that they don't
Yeah.
have to compete, okay, if it goes into the next week, maybe even the second week, then I'll write it off.
Yeah, they don't have the appetite for that.
Yeah.
frenzy.
Yeah, blame them.
But then they end up in multiple offers when
Yeah.
they've waited a week or 2 weeks, because
Yeah.
that's multiple people thinking that same thought.
They didn't realize that not everyone's waiting for offers, you're waiting for view of.
Right.
Maybe viewing is the right word.
And I feel like going back to them buyers backing out. Whether you're the listing agent or the buyer's agent, can't really be comfortable once you're under contract. Till you get to closing, because weird things are.
Yeah.
Can you guys hear us on Zoom?
Who do we have on Zoom?
I know,
Yes,
Scott, Andy, and Nancy.
yes.
Okay, good.
if you have anything to add, just, jump in. Or any topics you want to discuss. So.
At what point do you think about reducing the price on a house after it's, I mean, I'm sure every house is different, but just a $400,000 to $500,000, they're just a good house and it's been on for 2 weeks. Is that about the time where you talk to the seller and you're like, hey, 2 weeks and we just haven't had any activity, or do you wait 10 days? I mean, what do you think?
I mean, I think it does depend on the activity, that you've had and the feedback that you're getting.
If you have really good showings, and I mean, you've had a lot of showings, I mean, you've had a lot. But if you're not getting any offers within a couple of weeks, it's priced too high maybe.
So the algorithms show that if you have no offer, this is transcendent all markets. Algorithms show that if you have no showings, you're probably at least 3% too high. If you have a ton of showings and no offers, you're probably still at least 2% too high. Likely, if you're having no showings, you're probably 5% or more too high. Because we still, if you really look at the inventory levels, we still have inventory that is probably 65% of equilibrium. So we have, we kind of have the worst of both worlds, although we've all kind of hung in there. I don't know how. But we have low inventory and low demand. So the only reason that we are having any competition is because we have inventory levels that are 2/3 of equilibrium. So when you think about showings and you think about offers, if you don't have offers if you had, like, for example, if you had 15 showings on a $400,000 house or $500,000 house and you don't have any offers, you either have one of two issues you have to solve for. You either have to make a fundamental change to the house. There's something it smells like urine.
It's only 2 bedrooms, it needs to be 3.
Right.
Or
Things that you
staged,
can
or
fix.
like staged really.
Yeah, there's things that you could fix. You either need to change your circumstance
Physically change that.
or you need to change your price.
Yeah.
Because if you've had 15 showings in a $500,000 range and you don't have an offer, that means that you either have a fundamental issue that is making it not marketable once people get there, or you're just priced too high in the market and you need to adjust to the market.
Have you looked at what else went pending in that same time frame in that price range?
Oh, I was just curious just on when I've had it sold, but we had 10 showings and only one. I thought I was gonna get 3 or 4 offers, and only got 1 offer. And it hasn't closed yet, so so I was like getting to the point where I'm like, God, am I too high on the price? And so.
But sometimes it's interesting to look at what did go pending, that
And I
was
did, I
competing with
watched.
yours.
And I know why mine
And
didn't.
was it bigger and what was better or different?
Yeah, I didn't have a garage and a couple things, but.
Sometimes that conversation is before the reduction. Having that
Before the
conversation
listing
early
even
and not setting, I
tease
think
it up.
people's expectations that aren't maybe in the industry are thinking things are still selling in a day or 2 days, or their neighbor told, their friend's aunt told them that it'll sell in 1 day, and
Yeah.
so.
I like to talk about it at the time of listing so that they're kind of prepared for, they start getting anxious depending on the activity too. And they'll say, is it too early to reduce it? And we're like, well, let's give it.
Well, it's like frustrating too, because there was one right around the corner that Peter and Jennifer had, and it was listed at like 515. And all of a sudden I look and I knew it was can get multiple offers, all of a sudden you raise the price to 550. And I know what the appraisal already came in at, all that, I'm like, geez, I thought my house wasn't as big, didn't have a garage, a lot nicer house. I didn't get over it. But I know, I was on a busier street, things like that, but it's frustrating when you see some other ones getting multiple off, and then you're saying, why am I not?
Well, and that, but and there begs the question that I think Carrie's trying to allude to, which is pricing out of the chute is so important. Because if you have either a very desirable area and you're less than, let's say, 500 or less, or you're in a, you're in a price point of 300,000 or less, theoretically, the argument is that you can't underprice the house.
Right.
Because if you underprice the house, then it's gonna create more demand. And it goes back to our original conversation about the fastest way to, the fastest way to get 300,000 for, to get $300,000 price for a house is the price at 285. The fastest way to get 285 is the price of 300. So, the notion that people feel like they're gonna leave money on the table, it's a pretty defined market. So rarely is it gonna be like, oh, we priced it at 275 and it's worth 280, and we're just gonna get an offer the first day. I mean, as long as you slow play it. Now, if you list it on a Monday at 9 AM and you get an offer at asking price at 9:30 and they want an answer by noon and you have 17 showings, you gotta use a little common sense, right? You gotta let it play out a little bit. But if you're putting on the market on a Wednesday and you're saying, look, we're going to, let this play out a little bit, I wouldn't ever say we're gonna accept offers at this point. I would just say the seller's gonna evaluate these. I'm forwarding them as received, and we're gonna evaluate them on a per case basis, but likely we're going to make a decision sometime on Friday or Saturday, if you've got the activity and you've got the offers coming. But, it's funny though, we have all these price reductions and everybody's like, oh, houses are selling for less money. Well, they just aren't. Now they're selling.
They're just listed.
They're listed too high, because what we need to have a conversation with ourselves about is what is our ability to communicate with the seller the best pricing strategy versus just acquiescing because we don't want to lose the listing. And that's a real happy medium. And Audra alluded to something that I think is so valuable that we need to consider, and that's when you have data points from the neighborhood, particularly if it's a homogeneous neighborhood. So if you're like in a celebrity neighborhood and you know that model or that particular style home or model square footage is sold for $200 a foot above grade, and you've got somebody who says, oh, well, I just think our paint colors are so much nicer and we're gonna charge $10,000 more. Well, they're setting themselves up for failure. And if you can show them that price point and you can say, look, here's homes that have sold in this neighborhood, they've sold at 99.3% of the list price. That gives you an indication of how well defined the market is. This is the data that is supporting the strategy. And I don't want you to get anything but the optimal price and terms for your house that you want, but it's my job to explain to you why I think that's the case. And if they say all that and they say, I still want to be 310, you say, we leave this room together, we shake each other's hands, we look each other in the eye, and 310 is my marching orders, and that's what I'm gonna go get. But it is absolutely, pricing strategy is absolutely an indicator of the ultimate close price success that you're gonna have. Because you never get a second chance to make a first impression.
The
You
house
just don't.
down the corner, would you say now is under market, maybe? I mean, all
I think they
indications
paid,
would.
I think they really, the people really wanted the house. I talked to, is the Manhards. I mean, I talk to them all the time, and they seem to, they do, of course, a ton in my area where I live, and they seem to do very well at getting multiple offers on their houses, because they do list them a tad bit lower. And they always list them and no showings for a couple of days, gets everybody all excited, and it works.
It
I mean,
works.
they get, they surprise me. I mean, so I think I just priced mine maybe 5% too higher, so. And maybe that was the problem, because we got pretty much almost asking price, but I thought we were gonna get more offers.
Well, and what's funny is that we're talking about 2 weeks being a really long time, right? We already just gotten
Yeah.
so
Start worrying.
into that mode of, 2 hours.
Well, yeah.
Well, it really depends, right? How defined a neighborhood is and how defined the inventory is. I mean, if you're gonna Like, we put one up in El Dorado a couple months ago, and they really wanted it to be 285, and I was like, the comps were really telling us like 275. You know, we could go 280, I really think 275 is the number. And then, you know, we had a bunch of 275, like 4 offers right at 275, not escalating. Then we had a couple escalating, and then we had one, you know, that was kind of an outlier, and it's like, you kind of have to get people engaged, that's part of it. People want, we talk about buyers right now, and they're kind of in that, I don't think they really want to buy, they just kind of have to, because who would? Prices are high as they've ever been, and interest rates are double what they were 3 years ago. So who wants to really buy right now? Economics. They just, I mean, so they kind of have to. So if somebody else is willing to pay the number, it almost substantiates the value. So if you price a little low and you get multiple offers, and then people like to win, right? Nobody likes to lose. I've never met anybody who really likes to lose. I love to lose. Nobody likes to lose. So when you create that environment where it's like they're engaged, then you have an incredible opportunity to create that fervor and that frenzy that we felt so dramatically, just organically in 2021 and 22. So that's really what we want to do. The best thing we can do for sellers is explain pricing strategy, and being 1% under the market or 1.5% or 2% under the market makes all the sense in the world. Now you get to $1.5 million or something, different story. You know, then that becomes kind of a different dynamic. But even then, you know, we're seeing more interest in luxury. I think 600 to $1 million is tougher than $1 million and up, because there's a lot of cash buyers in them, because they have high net worth.
Question based on kind of some of the stuff you just said. So you're listing a house, you anticipate you're probably gonna have some multiple offers. Do you know, they wanna look at all the offers on Saturday, and you get, or you don't put that in there and all of a sudden you're getting a bunch and now they want to hold offers. So I'm finding that.
I would never in today's environment say, like, remember in 20 when it got popular to say,
Yeah.
seller will review all offers Sunday at 5 p.m. You never want to do that, because for a couple reasons. First of all, you don't want to do it because you got egg in your face, you got to get out of the MLS. I love the people that don't take it out of the MLS. It's like 3 weeks later, and the agent.
Open house.
Like that's
March 2nd.
Right. Yeah, exactly. So you don't want to do that. The other thing I don't think you want to do is you don't want to say, for a couple reasons. The other thing is you don't want everybody coming in and looking at the house on Sunday and you don't have any offers, and then it rushes them, and then maybe their agent's lazy or whatever. So you don't want to do that. You want a constant stream of activity. And then what you can say is, look, everybody says, we have to respond to them. It's 5 o'clock. Now, I think you need to be polite and communicate. You don't have to do anything but pay taxes and die. That's a beautiful thing about it. So you don't have to give them a response to that offer. So what I would say, this is exact dialogue I would say. Agent calls, my buyer wants a response at 5 o'clock. I appreciate that. And we are really working hard to get our ducks in a row and have a meeting with the seller to make a decision on how they want to proceed. My thought is, based on the conversation that I just had, that they will look at offers and we will probably be able to get to you by 10 a.m. tomorrow morning, not at 5 o'clock tonight. Is that acceptable to your seller? And oh, by the way, we're in a multiple offer situation. Could you please email me your highest and best offer? Obviously, the most amount of money and the cleanest terms will be looked at in the greatest regard. And oh, by the way, they want to close on June 15th. Will that be acceptable to your buyer? Do you want to send me that back? Now, if I have 2 offers, I'm going to be a little bit more careful the way I pose that. I'm never going to be rude, but if I have 9 offers, I'm going to kind of be like, yeah, your offer's full price, and I have 6 other offers that are either escalating that I'm going to go back and get highest and best, or are higher. So I'm not really concerned about your 5 o'clock expiration, although I'm not going to be an asshole about it, but I'm just going to say it in pretty certain terms. So what you do is you rely on your obligation, your seller. You say, I'm in constant dialogue with my seller. They are arriving at a determination about when they want to discuss this. My thought is, based on the conversations we have, they are likely to make a decision by 10 a.m. It's the seller's decision. And then I think you can have this, but I always tell people, and I always tell the truth, it never is good to not tell the truth, but I always say, you know, if they're competitive, then I'll say, you know, I would hang in there. You know, you're competitive. You know, but I can't guarantee you're gonna get it, but you're in the running. And agents, they love that, oh, we're in the running, you know, and then they, you know, then they go back to their person and, you know, so.
Have you told them they're not in the running and they're
No.
going after their people?
No, I never, well, I will.
People ask
I've
me,
done it when
are
I
we
have
still
one.
competitive? And I will be honest and say not right
Yeah.
now after what, I will share that.
If they
But
ask.
I don't offer that.
Yeah, I agree. I think the protocol is that they ask, you to tell them, you know, to say, I always say this though. It's not my decision, it's the seller's decision.
Always, yeah.
However, objectively, I think there's some work to do on your own.
I've had the seller's agent tell me that we're not competitive. And then I go back to the buyer and they drastically improve their offer.
yeah.
So, I mean, you take the
I
information you
always,
can get.
like, in that intel, when you call the listing agent before you write, which
Yes.
a lot of us do, but some agents don't, you just get this offer. Anyway, that's one of the questions I'll always say, do you have multiple offers? If so, if we were in this range, is that competitive? Especially during the frenzy time when it was like, if your max is less than what they already have, then it's,
Right,
you know.
yeah, yeah. You can say,
And
"Can I
most
waste my time?"
agents, most agents are pretty forthcoming and will say, yeah, you're in the range, but couldn't go below this. You know, and I always say, don't tell me the exact number, I just wanna know. Would
Well-
we be able to compete in this range? And they're usually offer that.
Well, and the other thing is like, are they offering an appraisal gap?
Yeah.
You know, are they putting, you know, is it VA and we don't have the, you know, we don't have the pre-approval letter yet? Is it, you know, I mean, there's so many circumstances. The closing date, they've gotta be in, they're moving from Maine and they gotta be in on June 1st and our person's new construction's not done until June 17th. I mean, there's a myriad of circumstances that can, that transcends price, but I think just being polite and having a dialogue and being consistent with your communication, you can keep buyer's agents on the up and up. But I don't disagree with Amy or Carrie. It is fine to say, you know, there's elements of your offer
Yeah.
that have an opportunity for improvement to make it competitive.
Yeah.
That's an okay thing to say.
How do you word the appraisal? When you get multiple offers, you know, you're definitely over list. Then you gotta put something in there about, hey, if it doesn't appraise, you're still, I mean, what do you do with that?
Well, what I would say is, if I was down, for example, let's say we had 8 offers and 2 were pretty close. What I would do is I would go back and I would say, hey, in the event that we have an appraisal issue, assuming it's financed. In the event we have an appraisal issue, does your client have any appetite for closing the gap? Would they be willing to come up with some cash to close that appraisal gap? Just no uncertainty.
Okay.
And if they say no, or yes, or we'll do this much, or whatever, then you gotta weigh that. You know, I've had them before where we've had an offer at, let's say it was listed at $450 in the heyday, and we have an offer at $500. And they were gonna cover 10,000 of the appraisal gap, but I had an offer at $485 and they would do 20. You know, I don't know, I mean, now in Dundee, I would take the 500 because they're harder to. The more obtuse they are, the more I would take a lead, because the appraiser then has more wiggle room with the underwriter, because they can't. You know, if you're in celebrity, you can't be off 10 grand. If you're in Dundee, you can be off 50. You know, in celebrity, you can't be off 2%. In Dundee, you can be off 10%, and I'm gonna go appraise all day long.
Talking earlier about how buyers are getting buyer's remorse and everything right now, so they're all excited about how sure we can buy 50. But then the appraisal comes back and, I mean, and the appraisal comes back at 535, I mean, so you got 15 grand, they're not so excited anymore. I mean, so do you always kind of protect yourself and put something in about the appraisal?
Well, I sure do if I can. I mean, I try to do anything I possibly can to get to build a moat around my seller and the price. You know, if I have multiple offers, I'll make earnest money hard. I mean, God, 21, we would practically take their first kid as collateral. I mean, you know, you can do about anything.
What if they say you can have them?
Yeah, that's the problem. That happens in the real world. anybody interested in some 20-year-olds? Cause I hear the market is
Not
less.
of the girls, for sure.
But no, but in all seriousness, Chad, I think it is really important to look at, the circumstance. Now, you can overstay your welcome and people can say, shove it up your ass. So you gotta be a little, you've gotta carry yourself carefully. If you're not bombastic and arrogant and you're conversational and you're consistent with your communication and you're communicating very clearly and you say, hey, look, gosh, what do you think about, and you've got reputational value because you know the people you're working with. And you say, gosh, what do you think? We've got these great offers. I presume it looks like your client's so qualified. Do you mind if we make that earnest deposit instead of 5, 10 and only, and non-refundable unless a lack of performance by the seller? Could you do that for me? Sure. Can we get it? And I think it's gonna appraise okay, but what about, 10,000? We won't go the whole 20, but would really help, I think, the seller get over the hump if we could go another 10. If you've got rapport with that agent, now they can say no, but they're not gonna say hell. Really, when you're getting those terms at the end, a lot of those buyer's agents are gonna reflect your demeanor and the way they're communicating with their client. So if you're calm and you're reasonable and you're polite and you're humble, they're going to sense that, and that's the tone that they're gonna have with their client. But if you're like, I got 3 offers, either you come up 10 or the earnest deposit is non-refundable, and I just shoot that over and then take it or leave it, and these are the terms, and I send that counter over, you're not gonna get, it's Nebraska, we're nice. So a lot of it matters on the way you carry yourself and your demeanor.
And aside from that reason, and aside from it's just the right thing to do, you may have to go back to one of those and say, oh, my first one fell through. Are you still interested? No, you were a jerk.
Right.
Still interested.
And we all know those agents that really, are tough, and they get bombastic and they're arrogant and they think their time's worth more than yours. And, and here's the other thing, you get multiple offers. I'll tell people, if it's a coin flip, I'm saying, I'm not asking you to make a determination based on this. I'm just providing the information as your fiduciary. This agent is easier to work with. And they have a better reputation, in my objective opinion. And there are people that would say, well, you violated our standards, that's an ethics violation.
God, when are we not?
I don't really think it is. I think if you're voicing your experience and it's fact-based, then I think you can do that. And I think we owe it to our sellers to do that, because generally, again, the buyer takes on the personality of the buyer's agent, or vice versa. You've got a troublesome situation with the buyer's agent, and either they're caustic and they're making their client caustic, or the client's caustic, which is making the agent caustic. I pride myself on never changing my temperament regardless of what my clients do. My approach and the way I carry myself is gonna be the same no matter what. My client says, you tell them to stick it where the sun doesn't shine, I never wanna talk to them again, would translate to, they're not at a really great point with your offer right now, so I don't know that they're.
I worked with an agent that would literally copy and paste that type of verbiage from their buyer to me. I'm like, something's probably not a good idea. F-bombs in it, and I'm like,
You just can't do that.
Like, are you trying?
yeah.
That stuff matters.
Mm-hmm.
It just does. So, any other thoughts? Everybody's sick of it.
No, these are always so good.
Good information.
Yeah.
Real life. Andy, Nancy, good? We're gonna
We're
say
never gonna
goodbye.
say quite like that.